Bin Limited, a successful retailer, is planning to open a new store in a new shopping centre in Cork on the 1st of the 7th, 2012, and has made the following forecast for the first 6 months of trading. So you've got July through to December there, and then you've got the totals. So you've got sales and purchases. So number 1, the expected selling price is €50 per unit. Number 2, the cash collection pattern from sales or debtors is expected to be cash customers. 40% of sales revenue will be for immediate cash, and cash discount of 5% will be allowed. Credit customers. 60% of the sales revenue will be from credit customers. These debtors will pay their bills 50% in month after sale and the remainder in the second month after sale. Number 3, the cash payments pattern for purchases is expected to be credit suppliers. The purchases will be paid for in 50% in the month after purchase, when a 2% cash discount would be received. The remaining purchases will be paid for in the second month after purchase. Number 4, expenses of the business will be settled as follows. Expected cost. Wages, €50,000 per month payable as incurred. Variable overheads, €10 per unit payable as incurred. Fixed overheads, including depreciation, €60,000 per month payable as incurred. Capital cost, equipment costing €54,000 with an estimated useful life of 5 years and no residual value will be purchased on the 1st of July. This will be partly financed by means of a loan of €48,000 at 6% per annum. The capital sum is to be repaid in 24 equal instalments commencing on the 1st of August. The interest for each month is to be paid on the last day of each month based on the amount of the loan outstanding at that date. Required. Part A. Prepare a cash budget for 6 months, July to December 2012. B. Prepare a budgeted profit and loss account for the 6 months ended 31st of the 12th, 2012. C. What factors should be taken into account by DIN Limited in arriving at the expected sales of $3,600,000 for the 6 months of 2012? And that is 80 marks, 20% of the overall exam. Okay, so part A, prepare a cash budget for 6 months, July to December. So as you can see in the question here, there is cash in and cash out. So there's information on all of them there, okay? And all we care about is cash in and cash out in a cash budget. We do not include any non-cash items here. So your cash budget will look like this. You've got your receipts up the top, okay? And then you've got your payments. Your receipts minus your payments is equal to your net cash. Then you will add in any bank loan that you receive. You'll have a look at your opening balances, and then you'll have your closing balance then on the bottom as well. All right, and as you can see, your receipts, you were told in the question that you have receipts that you will receive in the month of sale, and then you will have receipts that you will receive in the month after and in the second month after sale. And the same goes with payments. You have purchases that you will pay after 1 month of purchase, and then purchases that you will pay after 2 months of purchases. So let's get started then with the cash receipts and the credit receipts. So you have to look here at your sales, your information for your sales in each month, and then the cash collection pattern from sales or debtors is expected to be 40% of sales revenue will be for immediate cash, and cash discount of 5% will be allowed. So in the month of sale, you've got your 40% multiplied by 95%, because 5% of the 40% is going to be a cash discount. Okay, and then credit customers. 60% of sales revenue will be from credit customers. These debtors will pay their bills 50% in the month after sale and the remainder in the second month after sale. So 50% of 60% is 30%. So 30% in the month after sale and 30% 2 months after sale. So 520 for July multiplied by 40% multiplied by 90% is equal to 197,600. 520 multiplied by 30% to be received in August and September is 156,000. So that's July's done. August 540 multiplied by 40% multiplied by 95% is 205,200. 540,000 multiplied by 30% is 162,162,000. September is 610,000. Multiply that by 40% multiplied by 95% is €231,800 in September. Then what we're going to receive in October and November is 610,000 multiplied by 30%, and we're going to receive 183 in October, 183 in November. So October sales are 630,000. So we're going to receive 40% of that, and then we're going to give a 5% discount. So that will work out at 239,400. And then 630,000 multiplied by 30% is 189,000 that we will receive in November and December. In November, the sales 640,000. 640,000 multiplied by 40% multiplied by 95% is €243,200. November is 640,000 multiplied by 30,000. We're going to receive that then in December, so 192,000. And then December, 660,000 multiplied by 40% multiplied by 95% is equal to €250,800. Then you tot all of those up then across the way like that. Okay, so there's all your total receipts, and then you can move on to your payments. So your payments here, you're going to take note of the purchases here for each month. Okay, so the purchases figure is what is important here. And then looking down part 3, it says the cash payments pattern for purchases is expected to be credit suppliers. The purchases will be paid for 50% in the month after purchase, when a 2% cash discount will be received. The remaining purchases will be paid for in the second month after purchase. So that is part 3 there. That's how we're going to work out our purchases. So we're looking at our figures here at the bottom all the time, so our purchases figure here. And what I would suggest you do is you write down, plus 1 month, 50% multiplied by 98%, and then 2 months after multiplied by 50%. So in July, you're going to be paying July's in August and September. August purchases, you're going to be paying for them in September and October. September's, you're going to be paying for them in October and November. October, you're going to be paying for them in November, December. November's, you're going to be paying for them in December and then January next year. And then December's, you're going to pay in January next year and February next year. So let's get started. So purchases then for July, 220,000 multiplied by 50% multiplied by 98% is €107,800. And then to get the 50% of that, 220 by 50%, 110. August, then you've got 240,000 purchases multiplied by 50% multiplied by 98% is 117,600 that is going to be paid for in September. And then 120,000 of it, 50% of your 240,000 purchases is going to be paid for in October. September's purchases are €270,000. €270,000 multiplied by 50% multiplied by 98% is €132,300, which is going to be paid for in October. Then 270,000 multiplied by 50% is 135,000, which is going to be paid for in November. Now on to October's purchases. So some of it is going to be paid in November and some in December. So 280,000 multiplied by 50% multiplied by 98% is €137,200 that is going to be paid for in November. And then 280,000 multiplied by 50% is 140,000 that is going to be paid for in December. Then November's, so 360,000 multiplied by 50% multiplied by 98% is €176,400 that is going to be paid for in December. So that is your purchases done. Next we move on to wages. So wages, €50,000 per month payable as incurred. So that just goes straight in there, €50 every single month. Then the next expense is variable overheads, €10 payable as incurred. And we are going to look at the sales Okay, so looking at the total sales revenue, we want to know how many units will have been incurred in each month. Well, we are going to divide the sales by the expected selling price per unit, which is 50. So if we look at July sales 520,000 and divide that by €50 per unit, that is going to be 10,400 units. Multiply that by the variable overhead, which is €10. So that is €104,000 there. In August, you're going to look 540,000 divided by 50 euro is 10,800, multiplied by €10 is 108,000. September, 610,000 divided by €50 is 12,200, multiplied by €10 is €122,000. October, 630,000 divided by €50 multiplied by €10 is 12,600, multiplied by 10, is 126,000. November's 640 divided by 50 is 12,800 units, multiplied by €10 is €128,000. And lastly, December's €660,000 divided by €50 is 13,200 units, multiplied by €10 is €132,000. Then we're going to look at the fixed overheads. So fixed overheads costing €54,000 with an estimated useful life of 5 years and no residual value will be purchased on the 1st of July. Okay, so a cash budget. Remember what a cash budget is. A cash budget only looks at cash in and cash out. It does not want you to include any non-cash items such as depreciation. So therefore, we need to take depreciation out of the cash budget. So the fixed overheads including depreciation is 60,000 per month. So we want to find out how much the depreciation would be then per month. So looking at the fixed asset equipment costing 54,000, that is the only fixed asset that we have in this question. So €54,000, all right, it has a useful life of 5 years. So €54,000 divided by 60 months is €900 per month. So €60,000 minus €900 per month is 59,100 fixed overheads without depreciation. So our depreciation €900. So take that out, gives us 59,100 in every other month. Then we put in the €54,000 for our equipment that we purchased in July. Now we want to have a look then, is there any loan repayments or loan installments, or loan interest? So let's give this a read. So this will be partly financed by means of a loan of €48,000 at 6% per annum. The capital sum is to be repaid in 24 equal instalments commencing on the 1st of August. The interest for each month is to be paid on the last day of each month based on the amount of the loan outstanding at that date. Okay, so there is not going to be any loan installments repaid here because it's after, there is going to be loan repayments, not in July. It's going to be after July in August. So August, September, October, November, December, we have €2,000 per month. So none in July. Why? Because they commence on the 1st of August. So 24 equal instalments and your loan was 48. 48 divided by 24, €2,000 per month. Then the interest for each month is to be paid on the last day of each month based on the amount of the loan outstanding at that date. So let's think about the interest here. So the interest in July, the loan that we have outstanding at that date is €48,000. So €48,000 multiplied by 6% multiplied by 1/12 is €240,000. Then in August, when we've repaid €2,000, the amount of the loan outstanding at that date is €46,000. 46,000 by 6% interest rate multiplied by 1/12 months is €230. Then in September, the amount of the loan outstanding at that date would be €44,000. Multiply that by 6% multiplied by 1/12 and that is €220. Then in October, The amount of the loan outstanding at that date, €42,000, multiplied by 6%, multiplied by 1 over 12 is €210. Then in November, we have €40,000 multiplied by 6%, multiplied by 1 over 12 is €200. Then in December, the amount of the loan outstanding at that date is €38,000 by 6% by 1 over 12 is interest of €190. Then you tot up all of your payments and you should get the figures as you can see there. So your net cash, then you get your net cash by taking away your total payments from your total receipts. So 197,600 minus 267,340 is minus 69,740, and it goes on the same way going across the board there. Now your bank loan, you got your bank loan in July and it was €48,000. There were no other loans received then for the rest of that 6 months. There was no opening balance. All right, so the closing balance is minus 69,740 plus 48,000 is minus 21,740. That is the opening balance of the next month. So 34,070 minus 21,740 is equal to €12,330. That is the opening balance for September. €88,880 plus €12,330 is €101,210. That is the opening balance for the next month. 94,790 plus 101,210 is €196,000. That is the opening balance then of the next month. 103,700 plus 196,000 is 299,700. Then that is the opening balance for December. So 72,110 plus 299,700 is equal to 391,810. And that is the completed cash budget then for DIN Limited from July to December 2012. Next, we are asked to prepare a budgeted profit and loss account for the 6 months ended 31st of the 12th, 2012. So, unlike the cash budget, we are going to put in any non-cash items such as depreciation, discount allowed and discount received. So the cash budget, it's only for cash items. No cash items go in there, but in the P&L we will put in any non-cash items as well. So any non-cash expenses and revenues. So the sales, we have 3,600,000 and that's given to us in the question. We've got the total there. And the same with the purchases. So no opening or closing stock in this question. So 1750 is your purchases. Therefore, gross profit 1850. Then less our expenses. So our wages were €50,000 per month as incurred. So 50,000 multiplied by 6 months is 300,000. Then we have variable overheads. So we are just adding up our 104 plus our 108 plus 122 plus 126 plus 128 plus 132, and that is €720,000. Then our fixed overheads, 59,100 multiplied by 6 months is €354,600. Then our depreciation was 900 per month. So €900 multiplied by 6 months is €5,400. Then our discount allowed. We allowed a discount. So of our sales here, we give a discount to our customers who paid us in cash in the month of sale. So the discount allowed 3,600,000 multiplied by 20% cash customers multiplied by 5% discount. That is €72,000 there. Add them all up, 1,452,000. So that is 398,000 there. Then we will add the discount received. Now, we received discounts in the month after purchase. So we are only going to receive discounts in July. We'll receive the July one in August. We'll receive the August one in September, September and October, October and November, November and December, and December's we will receive in January. So this 1750, we're not going to receive anything for December. So 1750 minus 380 multiplied by 50% cash purchases, or the month after, sorry, multiplied by 2%, 13,700. So we are not going to receive the discount on December's purchases until January. So you can't put them into the P&L then for that, because we just won't have received it then. Then you take away the interest. So the interest, 240 plus 230 plus 220 plus 210 plus 200 plus 190, so €1,290 there. So net profit overall is €410,410. So that is the budgeted P&L complete there. The last thing that you have to do is the theory part of the question, which is part C. What factors should be taken into account by DIN Limited in arriving at the expected sales of 3,600,000 for the 6 months of 2012? So the last year's sales from other stores, maybe, so from competitors, market research or the opinion of sales manager and sales representatives, trends in the state of the economy, price to be charged, sales price, competition, luxuries versus necessities.